welcome. For today's interaction on the launch of HSBC India Export Opportunities Fund, I have with me Abhishek Gupta, Fund Manager Equities, HSBC Asset Management India Private Limited, and Sneha Suri, Lead Fund Analyst at Value Research. Welcome, both of you.
Hi, good morning all, and thanks for having me here.
Thank you.
Right. Now, Abhishek, could you start by explaining the primary opportunity that this fund aims to capture in the Indian export sector?
Yeah, sure. So I think what we realize is, and again, when we're doing our own side of some fundamental research and trying to figure out, obviously, India has been one of the strongest and the fastest growing economy in the world when it comes to the largest economies. But we were just kind of evaluating with whole impetus which the government has now put in terms of expanding India's export presence across countries, taking this number forward. I think government itself has given an ambitious target of about a $2 trillion export target by end of this decade, which is 2030. We were evaluating to figure out what could be possible opportunities as an investor for us to evaluate from that perspective. And we dwelled a little more on this aspect. We were ourselves surprised to come out with few of the very interesting findings. And let me share one or two with you. First, the general perception is when you look at exports, you're probably looking at either the domestic will do well or export will do well, right? Generally, the perception is both the engines don't fire together. But when we did this analysis, and not just India, but across the globe, we actually came across to a finding that export is kind of a very important nod in the wheel. So if you don't have exports, it's very difficult for a nation to attain its full potential. So whenever we have seen that exports have done well for global economies, it's similarly done well for the underlying GDP growth or the nation attaining its own potential. And whenever the exports have not been able to do well, the same repercussion have even been felt on the overall GDP performance of that country. So the economic growth to a great extent is based on a pillar of both domestic and export orientation rather than any single pillar specifically. So I think when we looked at export as an opportunity, we really believe that with India having already being seen that benefit which is coming to come through in terms of all the investments we are making towards manufacturing base, the fact that the government impetus is there, and incrementally again, if you go by somebody like a World Bank who has looked at what could be the possible economic scenario going forward, even they are projecting that the things are going to kind of stabilize or improve from here on. So these three things came together and gave us confidence that maybe this product overall could be a good opportunity for investor to diversify and yet find a good mix of both domestics and exports. So that was the initial thought about the product.
All right, and you did mention some numbers in the beginning, but can you please elaborate a little on what makes this the right time to launch a fund focused on Indian export opportunities?
Yeah, sure. So as you talked about, I think there are 2-3 important factors which gave us this confidence. So let me go one by one. And typically, like any other post earnings season quarterly result release, we go through the transcripts of the company. We try to find out, are there any specific trends which are emerging? Are we kind of seeing something which is playing out more at a top-down view? Luckily, when we looked at the transcript this time, we came across that the businesses which are a little more export oriented in nature, the management there started sounding more optimistic than what we have heard them in last 3-4 quarters. So they talked about concerns which are either related to energy issues taming out, the inflationary risk which most of the economies in the world were facing have started to tame out. Even if there were concerns on inventory, which was overstocked, has started to now come to normal level, or even discretionary spends where the client has come back to the table. So all of those things gave us confidence that maybe this is probably a good time to evaluate. As I said, we went and cross-checked with an external agency data, which is predominantly we found out what World Bank is calling out. Luckily, again, there is a trend emerging there that in 2023, the year went by, there were still 4 or 5 major economies in the world which were still in recessionary mode, right? If you look the same number by World Bank projections for 2024, there are about 2 odd countries which are in recessionary mode, others have come out of it. Luckily, the same projection of the World Bank for next year says that this number may actually be 0. So our understanding is the world is plateauing in terms of the impact of inflation and bad news and coming out of COVID phase. Companies or the sectors have started to sound more optimistic than what you have heard them recently. Last but not the least, as I said, the initiatives which have been taken by government, that again gives us a very strong footing that probably we are just looking at a nascency of this opportunity now. But from a next 2 to 4, 5-year perspective, there could be a big opportunity which can unfold here. So we found with all these factors coming together, this could possibly be one of the best time to launch a product like this.
All right. Now that you've painted a backdrop in which this fund has been launched, can you also walk us through the investment strategy behind this fund and how do you go about selecting the companies that make a cut?
Yeah, sure. So again, I like to kind of bring one point to notice. In general, it's a very diversified and a well constructed opportunity when you look at from an overall portfolio construction perspective, right? What we did, we put the initial two cuts to come first to a universe and number of name which can be available for investments. So we put a cut of at least 20% revenues exposure outside India. That's one. The second cut we put is business has to be more than $250 million of market cap, because that's where you get liquidity as an institution. Once you put these two things together, we were also surprised to see that we are finding almost 300 plus names as a starting point when it comes to out of it. So in general, again, we believe there are a lot of sub themes which could be part of this umbrella opportunity. So just think about it, right? We're talking about opportunities like manufacturing, we're talking about opportunities like auto ancillary exports, textiles, chemicals, tech, and you name it. Almost everything is kind of falling part of this story. So that could easily be a very diversified, well diversified portfolio, which could have at any point of time between 8 to 12 or even higher sectoral exposure. Again, when it comes to selecting or running a portfolio, we want to run it more on an ethos of a multi-cap strategy. So we want to have a good blend of large, small, and mid, where predominantly, intuitively, we want to normatively run it about 50-50 bucket each. 50 large, 50 small and mid. Again, when you look at the constituents or the number of names we're looking at, we're possibly looking at between 40 to 50 names at the number of stock which will be held in this portfolio. So again, I think from either you look at diversification perspective, cutting through the qualifying export revenue delta point of view, the diversification across sectors, across market cap. Again, to our own surprise, it's pretty widely represented between large, mid, and small, with mid and small itself constituting more than 85% of the universe on day one. So that again, generally, as a house, we have a very strong view that mid and small generally lends you ability to generate more alpha over a longer period of time. Again, gives us confidence this product could actually be an alpha accretive product. So those are broader cuts which I wanted to share in terms of how the portfolio will look at in terms of the allocation.
Right, Sneha, I'd like to get you in at this point. From a broader investment perspective, how does the HSBC India Export Opportunities Fund compare with other thematic or sectoral funds currently available in the market? And
Yeah.
also, what should investors be aware of when considering this fund as part of their portfolio?
No. And again, I think I've been trying to demystify this thought for all our prospective investors, and good that you asked me this question. As I told you, on day one, if you're looking at a universe which is possibly at least 300, 310 names to start with, first of all, we don't believe it's a very, very concentrated portfolio in terms of exposures or in terms of concentration. So in our mind, as I told you, even we are going to run it more on a multi-cap ethos, right? So for us, it's a truly diversified opportunity. What will not be represented here is again sectors which are overly exposed to domestic. So let's say a sector which is not making a cut of at least 20% revenue coming from export may have some underrepresentation. But again, if you think through it, I think any other diversified strategy you take, whether it's a multi-cap or a flexi, invariably you find pretty good representation of these sectors in a typical diversified strategy. Now, our view is that, and again, there's a very interesting data which is again coming from the government itself or the projections of the government agencies. They're saying that export as a bucket, as I said, told you, is expected to go from $783 billion today to $2 trillion by end of this decade. That translated to almost about a 14-15% annualized CAGR. Same agencies, if you look at what they're talking about in terms of India's overall GDP growth, they're looking at about 10% CAGR when it comes to India's GDP, because these are dollar nominal numbers. So clearly what we are saying is that from a representation perspective, this portfolio will have representation to the part of the opportunity which is expected to do better than the underlying economy, right? 10, 15, 14, 15% versus 10%. So that's a very important cut to be kept in mind. And as I said, any specific theme which generally has caught kind of investors' appetite today, whether you talk about manufacturing, you talk about auto engineering, you talk about energy, you talk about innovation, you talk about manufacturing, all of them are actually going to be represented in this portfolio. So for an investor, one has to look at it as a truly diversified strategy, which just gives you that over indexation to export, which in our mind we believe is going to grow faster than the domestic opportunity, and that is where exactly the blend of the portfolio will also look like. So I think it's that's what also differentiates this product from a typical otherwise diversified strategy. But in general, in our mind, it is not a thematic, it is not a sectoral, it's a truly diversified strategy.
All right. Sneha, what do you have to add to that?
Right. So generally, when it comes to sectoral and thematic funds, they vary widely, each focusing on different sectors or theme. This makes comparisons tricky since performance actually depends on the specific area fund targets. Maybe it is diversified in one sense, but it does have some niche kind of exposures. However, what is, important to know is that at any point in time, some sector or the other is going to do better than the markets. And that is, even today the case. Because that's in the nature of the markets. The equity market on the whole is the average of all its components. And obviously, some parts will be better than the average, and some, of course, will be doing worse. While many thematic funds cover broad areas like infra, tech, banking, this one, the HSBC India Export Opportunity Fund, focuses specifically on companies benefiting from India's export growth, like Abhishek mentioned. This actually positions it differently, and currently there is only one other export focused fund available in the market. I would like to actually mention the fact that sectoral and thematic funds can be typically volatile, swinging between extreme highs and lows. And a case in point is the recent market downturns that actually saw high flyers like defense, PSU, and energy funds drop by around 35 to 45% more than the Sensex. So when it comes to thematic or any niche kind of strategies, since these are cyclical, caution is generally advised for investors when considering these kind of funds.
Right now, as Sneha mentioned that, at any given point, some sector does better than the others. And we have seen that IT services and pharma, they've been leading Indian exports for a long time, almost decades now. So looking ahead, which sectors do you think will take the spotlight in driving India's export growth over the next decade?
No, I think point well taken. And clearly, let me again set a backdrop here for the benefit of our viewers here. So, as I said, India currently is about $783 billion of export, what we generate annually. If you split it between goods export, all call it merchandise export, it's about $441 billion. And if you look at the services export, which is where typically the computer services, technologies, and some bit of insurance, finance, logistics comes into play, that's another basket of about $342 billion. Now, if you think through it, as you also mentioned, tech has been India's calling card when it comes to our presence on the world scale. But the good data here is that we are still, despite doing well there, are not over-indexed or over-represented. So let me put some number here. India's current GDP as a world GDP is in ballpark range of about 4%, right? And we are the fifth largest economy in the world. You think from a services exposure perspective, India's market share in services export also today is about 4.3%. So ballpark equal to our GDP size. Again, coincidentally, India is also the fifth largest service exporter in the world, and we are the fifth largest economy in the world also. So again, in my mind, we are not over-indexed there. It's just that we are fairly represented. The problem, which is where I think a lot of efforts have incrementally been put in, is on the merchandise side of the story. First of all, the merchandise export basket is 3 times the services export basket. So it's a bigger opportunity at play. If you look at India's market share there, we are about 1.8% of global merchandise exports market, while that makes us the 17th largest. As I mentioned you, we are the fifth largest economy, but we are only 17th largest when it comes to merchandise exports. So clearly, I think even if you look at either the government initiative where they want India to increase the manufacturing base a percentage of GDP from 15% today to 20% going forward, I think a lot of realization has seeped through that India has to kind of integrate itself on the global value chain. And in that process, there have been a lot of efforts which have been put in. In our mind, the efforts which have been put towards PLI initiatives, right, where almost 14 different industries have already become part of this initiative. These are the businesses which are starting as import substitution story, but they eventually will become big opportunity from an export perspective also. So as you mentioned, yes, historically we have done well when it comes to our pharmaceutical export, our tech exports. But if you think through it, right, incremental opportunities are numerous. So auto engineering, a space which we have been doing well and will continue to do well. The capital goods and the machinery exports opportunity, again something where we have been doing pretty well and we are incrementally gaining more market share. Even some of the new sunrise opportunity. So you may talk about possibly defense export is something which India wants to again tap into the opportunity. The whole electronic manufacturing base which we are doing today as import substitution, but eventually these business company becoming big enough to do exports could be another potential opportunity for us. Chemical is something where we kind of had a more stop start, but maybe looks like again with the right focus towards his specialty rather than the commodity aspects of chemical, we can even gain more opportunity on that side of the story. So I think there are numerous sectors like textiles, right? I think it was India's one of the prominent spaces a while back. We lost our market share, but I think India incrementally again started investing in diversifying the whole value chain. So from being just a yarn manufacturer or a fabric manufacturer, we are going up the value chain in terms of producing ready-made garments, maybe looking at the protective gears, technical textile. So I think a lot of, and that's where our comfort coming from. If you look at, there's a very interesting study by Bain Consulting, which is saying that for India to hit this $1 trillion export basket number on merchandise, there are 5, 6 sectors individually which are going to contribute. They mentioned chemical, electrical, electronics. They mentioned obviously in terms of your the automobile. They talked about textile. So the good part is India is not a one or two trick pony here. We will have enough and more sectoral representation to find and capitalize on this opportunity.
Right. But with all the talk of de-globalization lately, how is the fund positioning itself? And do you see
Yeah.
this trend of de-globalization impacting Indian exports? Also, if so, how might that play out?
Yeah. No, it's a valid question. And to be fair, when we dwelled into this aspect, we got comfort from two aspects, right? First of all, we mentioned that the qualifying criteria for a stock to be part of this portfolio is 20% exports. When we ran these more on our, as you say, iterative model portfolios to just see what could possibly be the general concept of the portfolio, we realized that on average, we were getting about 40-45% revenue orientation from exports. A corollary to that is still you're getting about 60-55-60% domestic exposure. So although it looks like an export-oriented product, and it is, but it's not entirely putting baskets or all eggs in one basket of export. We're still maintaining a pretty judicious blend of when it comes to domestic plus exports. Second point, and this is also very important, I think across the world, there is an effort to obviously prioritize nationalism, right? All of the countries want to create their own manufacturing base because you want to diversify your supply chain base. There are geopolitical concerns which are also at play. And clearly, you want to generate employment opportunities in your own country. So, with that backdrop, I think why India still has an edge when you compare with most of the other competitive countries per se. So, we bring to the table skill, scale, and size. Now, these three opportunities, very few countries world can offer you all these three opportunities combined, right? So you would have heard opportunities like China plus one, Europe plus one. So clearly, I think whenever the world looks for an alternative for something who can offer you both skills, scale, and size with cost arbitrage, India by default crops up as one of the alternative. And again to put this number in perspective, so we also looked at that. Assuming the world economy takes its own sweet time to recover, but has India has been gaining market share with all this backdrop of nationalism and deglobalization. So the sweet data point which came across is we looked at not just 5 years window, but we looked at from a 24 years window starting from start of this century. Luckily, India's market share in the global export was somewhere about 1% start of this century, which is 2001. Today, at an overall level, we are 2.3%. And even more surprisingly, no matter the business cycles have gone through their own share of boom and bust, but India has invariably been only gaining market share when it comes to global scale and size. So I think, yes, at some point of time, nationalism is prevalent across the world. But then if you think from an importing country perspective, right, a very important point to highlight here is a country imports because it wants to import deflation. And to import deflation, you still need to find partners whom you see as more neutral or friendly partners who offer you advantage of cost and skill, and who can ramp the capacities and the production ability which meets your requirement. So all those coming together, I think India is still a very sweet spot. And yes, there could be some instances where there could be some volatility in a one or two sector, and that is why I told you that given we are looking at almost 12, 15 sectors as an opportunity, one or two sectors may have their own nuances, but overall it will not derail us.
Right now, before we wrap this up, one last question that I'd like a word from both of you on. So, who do you think this fund is best suited for? And is it more for investors with an appetite for risk, or can it also find a place in more conservative portfolio? Abhishek, why don't you go first?
Sure. So I think, and that is where, if you go back to our discussion, I've been highlighting that in my mind, it's a truly diversified opportunity. So if it was only looking at specific set of industries, or if it was looking at only a very small universe of selection, I would have said that yes, there could be a heightened sectoral volatility because of different business cycles which can impact. But given we are looking at a very broad basket of overall diversification, this product could be seen as somebody who is a medium to higher when it comes to risk-taking appetite, right? We believe that it should be evaluated as a core strategy, not as a satellite strategy, because as I mentioned, it at a very arm's length level gives you an exposure which is very similar to a flexi or a multi-cap strategy. Just that you are getting a better representation of export here, which probably wasn't the case in the other two names which I mentioned. If we believe from a longer term duration perspective, you are getting a better opportunity from export as a basket growing faster. That again can compensate to some amount of incremental risk which can come into play because of geopolitical uncertainties, which is by default are given here. So in my mind, anyone with a medium to a higher risk appetite is well suited for this product. Given we are looking at export unfolding over next 5-7 years, my request to all my prospective investors is give this product a 3 or 5 year window minimum, and that is when you will reap the maximum benefit out of this.
All right, Sneha, what's your take on this?
Right. So like Abhishek mentioned that, some kind of risk appetite is required. And, equity, when it comes to equity funds, be it diversified or sectoral, generally these kind of funds cater to those with a higher risk appetite and a longer time horizon. For the sectoral and thematic funds, the theme or sector specific risks make them better suited for risk takers. But I would like to mention that, flexi cap funds, on the other hand, offer a more diversified and balanced approach by investing across various sectors, and sectors like banking, tech, consumer discretionary, which actually helps reduce the dependency on some particular sector or a single sector risk, if I can say that. Now, interestingly, there's a 35 to 50% overlap between the only existing export focused fund in the market, and the overlap with that fund is with the same AMC's diversified funds like value oriented and flexi cap. So generally choosing a more diversified approach doesn't really mean that investors would be missing out on key opportunities.
All right, with that, time for us to wrap up this chat. Thank you both of you for taking the time and having this interaction. Thanks.
Thanks, Ruchira, and thanks, Sneha, for your time. Pleasure interacting.